This morning I'm going to be covering the responsible investing and specifically how it relates to passive investing. So, of course, one of the big benefits, and I think Amy has sort of covered some of the benefits of passive investing, but for us, it's always been that passive investing is a simple investment. It's easy to understand. If the markets go up, the fund goes up. A lot of effort went into designing our core range in such a way that we don't have to go and explain relative performance risk. Now, responsible investing adds another layer of judgment. So you are, to some extent, introducing the possibility for noise to enter into the system. And so one has to be quite careful in terms of how one incorporates it. And I'm going to cover a lot of those like nuances. As a starting point, as I said earlier, the core funds were designed to be simple, low cost, and broadly they've delivered on that promise. So, if you have a look at the returns of the fund since the inception, our oldest funds is the core diversified and the core guarded funds. Both those two funds now over 10 years are among the top two best performing funds. And I've had many investors over the years coming to me and says, shit, I didn't actually quite expect these funds to do so well. Well, you can see that actually across the whole range, you get similar kind of performance numbers. And I think to some extent, for those of us that have sort of looked at the investment theory over the years, it's to some extent something we expected. Now, investment theory broadly predicts that the average asset invested in the market should give you a similar return or the market return will be equal to the asset weighted return of all the market participants in that given market. And that's basically what we found in a recent study where we looked at each of the individual fund categories and we went and calculated what the peer asset weighted return was per fund category and compared that to a representative passive fund before you take fees into consideration. Now, as you can see on those two graphs, we've basically compared the multi-asset high equity space to the core diversified fund and the multi-asset low equity space to the core guarded fund. And you can see in both cases that the peer-weighted, asset-weighted return before fees and the core diversified and guarded returns before fees are very similar. And that's broadly what your market, or what your investment theory tells you. And we found that across equities, we found that across global equities and bonds as well. And so broadly, what we're seeing is in line with what investment theory predicted. And then, of course, because these funds have much lower fees, after fees, then they have got quite a big advantage. And and that's basically been one of the biggest drivers of the success of the funds and why they have been within the top 4 or 5 funds since the inception. Now, like I said earlier, the way we've designed the funds, the way they've performed consistently, they're never right at the top or right at the bottom, but over time that those fee differences compound, has really made these funds sleep easy funds. They are the one fund that I think most advisors don't really have to worry about. They know what they're getting. That is because those returns are basically just linked to the different returns of the different asset classes. Now, Amy actually provided us with a different lens to why passive is also quite successful, and that's the whole concept of statistical noise. And to some extent, these funds represent the ultimate of noise reduction. And that noise reduction happens at 2 levels. First, at the underlying asset class level, where you're basically getting the aggregated asset-weighted judgment of all the different market participants in each of those asset classes. So you get noise reduction in each of those components. And then there's a further layer of noise reduction by only making use of strategic asset allocation. So broadly making sure that your strategic asset allocation is in line with the specific category that you invested in. You can ensure that additional noise is taken out of the system. And as we've seen, it's resulted in, over the long term, in really good risk-adjusted performance for the funds. Now, sleep easy investing is not something that is a stationary goal. It's something you have to continuously work towards. And at Net Group Investments, the way that we've looked at it is that we don't think that you can provide these sort of like sleep easy investments unless you have a lot of focus and a lot of energy that goes into continuously improving your funds. There's a lot of changes that happens. There's a lot of risk in the sense of launching fad funds. You would see, just in the equity space, you can get 4 or 5 different plain SA equity indices. Then you can get these dividend trackers. You can get low volatility. So there's a lot of different products that could be launched, but don't always add value. I mean, a lot of them end up being fad funds. And I think our focus has always been to add value, to improve the existing range, rather than to go and launch a lot of different products. And one of the main reasons for it is that we're always living within an ever-changing landscape. You have to changing regulation. I mean, we've seen a number of changes to the offshore allowance within balance funds over the past 10 years. Also have to deal with different tax regimes, especially when you start investing overseas. Then more recently is the whole responsible investment. So, I mean, that's also changing the landscape. It asks for additional resources to be able to do the work required to be able to do responsible investing properly. So we ultimately think that by having a focused range, by having a range with clear goals, that we can deliver better outcomes over time for our investors, because effectively we do the hard yards. We go through all those different indexes that's available in the market, and we go and select the ones that are most appropriate within our holistic solution. From a business perspective, it also means that your resources are focused. You don't go and try and launch too many different funds, and then you basically bog your smartest people down in doing a lot of admin work. And then really for us, one of the most important is really that our investors know what they're getting. They know what they invested. They are not provided just with a lot of different investment products. Now, I mentioned responsible investing. So, I mean, recently, I don't know, Nick and myself have gone and read Bill Gates' book on some of the major risks to climate change that we are facing. And so this becomes now yet another thing to consider within that sleep easy investment scenario, because these are things we need to have a look at to ensure that those funds remain sleep easy investments. And I mean, I've highlighted a few of the main sort of like important points in the funds, which is two important numbers. We are emitting about 51 billion tons of greenhouse gases per year, and we need to get that down to zero by 2015 if we want to avoid a global warming catastrophe. It's also good to know where that global greenhouse gas emissions come from, and most of it comes from the things we make: cement, steel, and plastics. Secondly, it's the generation of electricity, and then it is growing things, getting around, our transportation, and then the last one is really like our heating, air cons, and heaters in winter. And so Bill covers the sort of the various considerations, the amount of work that needs to be done, and the complexity. And I think this is quite an important consideration when one sort of embarks on this responsible investment journey, is that none of these things are quite simple. They aren't simple little rules that you can just apply and everything changes. They are interconnected, and that also makes it difficult when you want to implement things like that within indexations, is that there aren't simple rules really that you can go and like necessarily focus on. I thought it would be nice to actually start with what is responsible investing. And so the Institute, the Investment Association in the UK has sort of put a nice responsible investment framework together that broadly has 5 pillars. Now, I believe the first one for me is the most important one, and that is stewardship. And I think in stewardship has been quite an important focus area within Ed Group Investments since its beginning, because I think it goes hand in hand with long-term investing. You have to look at sustainable strategies. You have to look at strategies that will work in the future as well, and it's not just a fad fund at this particular time. What we're doing with responsible investing is now we're applying a different lens. We are now looking at environmental, social, and governance issues within that long-term perspective as well. The other components, of course, of stewardship is your shareholder voting and engagement. And I think definitely as the drive towards responsible investing has become bigger and has gotten a lot more traction, a lot more managers are getting more active and more engaged in terms of how they think about how they're going to engage with companies and how they're going to vote. The second pillar is all around beginning to think about how ESG affects your investment process. And so in many cases, if it's like an active manager, they would start looking at what are the risks that are associated to these 3 factors in valuing a company, for example. Then one of the oldest pillars is exclusions. So the old SRI funds used to have specific exclusions that were norms-based, but you can also get exclusions based on values. And then more recently, if you start using some of these ESG criteria, you can use those for exclusion criteria. The fourth pillar is specifically focusing on sustainability. So these, maybe you get water funds. There's a number of range of these themes. I think some of them are problematic if they are too specific. And like I mentioned earlier, because so many things are interconnected, one can get into a case where you're not really getting what you're trying to achieve. But then you also get nowadays best in class and other optimized strategies that are focused on sustainability. And then the last leg is impact investing. And what makes impact investing a little bit different is that it doesn't necessarily have to be for profits. So there's a lot of examples of impact investing where it's specifically, let's say if it's socially related, it's done for non-for-profit purposes. There are, of course, still impact investment vehicles that are for profit, but within impact investing, you're actually getting almost to the philanthropic side of the investment framework. Now, in the investment, for a lot of people, the ratings are ESG ratings of company is a starting point to start having a look at ESG integration in portfolios. Now, a number of commentators have remarked to say that all these different rating agencies come up with different ratings. And the example here is Naspers. So you can see Naspers' rating with the MSCI. MSCI has given them an A rating, whereas Refinitiv has given them a C rating. And the question is it a positive or is it a negative? And I'm going to try and answer it by showing you some of the practical implications of having different ratings, specifically in the passive space. Now, quite an important part of the responsible investment and ESG conversation is really you don't want to run the risk of greenwashing. And so with greenwashing, I mean that you specifically want to capitalize on the demand for ESG type of products, and you falsely claim that these products are going to deliver specific sustainable outcomes for investors. And of course, you get the greenwashing on purpose, but then you also get the unintended consequences which can lead to greenwashing. And as a good example, I think we found by looking at optimized strategies, we found that most of them end up having some form of greenwashing in them. So as an example, one of the index ranges that were launched by MSCI recently is the Enhanced Focus Index range, where the idea is that you want the same kind of returns as the market return, but you want to get better overall ESG scores, and you want to get lower carbon emissions. And so the way that you go about it is that you go and create an optimizer. You don't want the performance to be too different, so you put constraints within that optimization. But unfortunately, what that process does is that you end up with higher, better overall scores. But at an individual share level, you actually end up sending a lot of mixed signals. And you can see it in the table where this is specifically for a purely carbon index, where when one looked at the deteriorators, in other words, companies where the emissions were getting worse, nearly half of them actually got upweighted through that optimization process. And so that sends very bad signals to the company when you want to engage with them. And our conclusion in the end is that with optimization, to a large extent, I don't actually think you end up achieving the necessary tools to be able to affect change over the long term. So what we've done over the past 2 years is to think, is there a way that you could go and implement ESG criteria within an index portfolio and have share level signaling? And so we came up with a methodology, and it was largely based that in the South African market, we've always had a problem with concentration risk. So currently we're sitting with Naspers. Naspers makes up about 20% of the market. Most investors don't want that kind of single security risk. And for that reason, Naspers gets capped at 10%. And then effectively that 10% gets distributed equally across the other 139 shares within the index, to reduce that single security risk. But effectively, the 139 shares end up getting a free lunch. And so we thought, well, if you put a criteria, a minimum qualifying criteria to get the free lunch, that would be a way to actually have clear share level signaling. And so we were quite happy when we designed it. But as we started thinking more and more about it, a lot more questions came up. So one, then you get into the whole, well, which data provider are you going to use? Which criteria are you going to use? And then it becomes difficult because you can't really necessarily say that the one is going to be better than the other. The second part is the sustainability of the strategy. So we may have a scenario where in 5 years' time, Naspers is no longer such a large business. It may have, like what we're currently seeing, we've seen that sort of like share exchange to process. And then you no longer have that sort of like a capped amount that you can pass on to the other shares, and then you can't actually implement the strategy. And so we broadly came to the conclusion that it's at this stage, it's very difficult to go and apply these kind of criteria into a passive kind of strategy. And the broad conclusion that we came to is that we believe that active and passive managers have very distinct roles to play. So on the active side, managers can actually go and incorporate these into company-specific risks because they invested in the companies, they can engage on those. They can go and do the trade-off of how those factors influences the various risk return trade-offs. And in that scenario, different ESG ratings is actually not a bad thing because they provide different lenses to active managers in terms of how those different companies think about how they rate that given business. And that's why I put the question mark in the beginning, is that I don't necessarily think it's a negative. This is to the point that Amy made, is that there is value in aggregation of experts. And I think active managers can benefit from that. We unfortunately can't go and create an index of all the ESG experts' views. It's just too expensive. Each and every one of those providers charge quite high licensing fees. And then the last point that Amy actually made a week or so ago was that it also provides a marketplace for subjective values. So, for example, we've got an active manager whose wife used to be a smoker, and she died of lung cancer, and so he wouldn't invest in any tobacco. Of course, that wouldn't appeal to everybody, but in a manager that manages a global portfolio, he's got enough of an investment horizon to apply it. And so you can then have more like authentic subjective values being applied. Now, within the passive space, we believe that the real role that passive investors, and we're already seeing it with Vanguard and with BlackRock, is the role of universal asset owners. So we own the whole market. We own the full 140 shares on the local side. BlackRock probably owns closer to about 10 or 15,000 shares globally, which means that we are buy and hold investors. And so where we're going to have our biggest impact is really through engagement. Because you don't have that ability to move in and out of the shares, you're holding those shares, and so engagement now becomes your most powerful tool. The other thing is also that because you're looking at the whole market and you're holding the whole market, the focus then shifts from being company-specific to systemic risks. So looking at what are the big risks that's going to affect the whole market, and it's going to affect all asset classes and all geographies. And so, I mean, climate risk was one of those, but there are many social risks as well. So as you can see, I mean, and I think this sort of illustrates that different market, and I mean, it doesn't just mean active and passive managers. There's many other stakeholders within the value chain that needs to be engaged on these factors. We, like BlackRock and Vanguard, have the benefits that we have both passive and active managers within our stable, and so we'll also get the benefit of those two engaging and having conversation, and each providing the insight from their given perspectives, which I think will also ultimately end up with better outcomes for on these topics. Another important stakeholder, of course, is also your parents. So, I mean, we are fortunate that we're part of Nedbank, and Nedbank's always been committed to, I mean, as it's known as the Green Bank, but there's actually across the ES and G factors, there's a lot of work that's always been done within the bank. We are continuously engaging with the bank, so in terms of getting ideas, getting from their research, actually providing some insight from our side. So the bank for us become quite an important stakeholder to engage in this process as well. And then within the broader Net Group Investments business, we also have the benefit that we look after a lot of funds that are managed by boutique investment firms. And so there is room for us to sort of nudge and have constructive conversations with those managers as well. And as you can see, this is something that we've now been doing consistently for the past few years. We're about to launch our latest responsible investment survey. As part of that sort of like conversation with the managers, we've broadly decided that we'll focus on 4 themes, because there are a lot of things that you can focus on. I mean, if you look at the PIC report that was launched not too long ago, if you look at various needs, I mean, I think there are over 20 different needs that you can focus on, but it's very difficult for any given business to actually go and apply themselves and really try and affect change if they don't have focus. And so we've focused on 4 of those needs that have got quite importance to both South Africa and global, which is biodiversity, climate change, diversity and inclusion, and human and labour rights. And so those will be our key focus areas for the coming years. One of the last parts, and I think quite important part to passive, is the shareholder voting and engagement. So our business model is that we outsource the asset management. What we've recently done is we've insourced the voting and engagement, and that's because our internal active team has always provided the voting guidelines, and we just found that it's more effective to actually just streamline that and to actually insource it completely. And then during 2022, we'll actually add additional resources so that we can cover the whole universe of 140 shares and really like embrace that universal ownership of the local market. Quickly, just for next year, I mean, our main focus areas will be focusing on the themes, building a behavioral strategy to engage the different stakeholders. Quite importantly, we are not experts on many of these fields, and so I think it becomes key to partner with experts that can help us along this journey. And then the last one is really investor engagement. I think there's an important role, similar to the conversations that we're having with our managers, that we can have with our clients in terms of creating further awareness, educating in terms of what are the important criteria and things to look at. And that's all for me for now. We just got questions from Tracy.
Thank you, Jannie. That was very interesting. I know it's been quite an interesting journey and we've learned a lot. So one of the questions we had is these ESG factors going to influence security selection in the core funds?
No. So, I mean, I think, like I've shown, I think it becomes very difficult to try and apply it at a share level. I think it's both, like I said, it is from the deciding on which criteria to use is difficult. And then secondly, practically implementing it and still having that sleep easy investment outcome, I think is difficult. And therefore, I think a lot of our focus will be more on the engagement side and focusing on the systemic risks, like sort of building out. I mean, we're focusing on those 4 factors over the coming years, but it's continuously evolving and saying where do we need to focus next on things that we believe are, like I said, systemic risks.
I think it ties in really nicely as well with Amy's presentation where she spoke about noise, and we saw that. I mean, it's been an interesting journey, as I said, because all the different providers, the small boutiques, the big guys, they all had different scores for the same shares. And so are you actually introducing noise or are you reducing it? And what is the implication?
Exactly. So, and I mean, I think that is the challenge, is that like, it's very difficult to at this point in time say one is better than the other. And I am with Amy in that sense. I think the aggregation of these views are going to be of value. And I think the way that aggregation is going to play out is partly through how active managers apply it, and then partly through how that information is used in assessing systemic risk in the engagement that universal asset owners, like passive funds, will have with their various stakeholders.
Exactly. So I think one of the other questions we have here is, how do you actually avoid these greenwashing funds? You know, it's not always intentional. And I mean, we also had that idea when we started out that we thought the fund was best, but how do you, when you're picking these funds, make sure you don't unintentionally end up in a greenwashing fund?
So I think it's important to understand that responsible investing is not a product. It's a change in mindset. It is a different lens that we are applying to the world. We're basically saying that there are more stakeholders. We can't just purely focus on profit. We need to have a look at the environmental impact of generating those profits, the social impact, and then of course the governance side in terms of making sure that you haven't got that you've got sufficiently diverse boards where you get sufficient oversight over those businesses. I think in products it's always going to be difficult, and I think the challenge is that as soon as somebody puts a label on it and it doesn't deliver what's on that label, people are going to be disappointed. And I think this is a long-term journey. I mean, this is not an overnight. This is, I mean, if you read Bill Gates' book, like it's complex. It involves a lot of stakeholders. It is governments. It is philanthropic organizations like the Gates Foundation, all that have to add to be able to get to that zero carbon emissions and improve some of the other factors as well. So, I mean, my broad answer is that don't think of it in terms of a product. Think of it in terms of a change of mindset, a change in behavior. And I mean, I think Bill Gates also pointed out nicely is that look at the things that you can do in your personal life in terms of the products you buy, etc.
I think it's very relevant, and a lot of people, I mean, I think what we almost did as well was unintentionally create this, and it is definitely, like you're saying, it is a mindset shift and change. And we don't have all the answers, and I don't think anybody does, but I'm sure we'll all learn on this together. So one of the other comments and criticisms is often, South Africa is not a developed country. We often think of ESG as carbon emissions and environmental. And so how does this actually fit in with the South African context?
Look, I mean, and I think if you look at those 4 themes that we're looking at, biodiversity, climate change, etc., is that a lot of those things will probably have a much bigger impact on sub-Saharan Africa. So they are really important, and we have to focus on them. The other component is that these things are all interconnected. We're part of a global world. So, I mean, like part of our conversations with global fund managers, etc., in terms of the work that they're doing, because, I mean, a lot of the research that's going to be required, the equipment that's going to be required to really tackle this problem are going to be coming from the developed world. So, I mean, I don't think you can just stick your head in the sand and try and hide from it. I mean, I think it is as relevant to us as it anywhere else in the world. In fact, like I said, it's going to potentially have a much bigger impact on emerging markets than it will on developed markets.
Oh, great. And then we had a few questions as well, not so much ESG focused, but more focused sort of on the rules-based aspect that we covered. And one of those was, should you be applying a multi-manager approach when you're including passive funds? In other words, should you have multiple passive funds when you're building a portfolio?
Look, I mean, if you are getting the same thing, then it doesn't really make any sense. I mean, I think if you look at globally, generally investors will pick a provider and they will use that provider for their passive investments. Some people are beginning to look at different strategies by adding a bit of smart beta, adding a bit of factor-based investing. And I think that sort of like speaks to the point that Amy made earlier about intermediation, is that you have to be really sure that you are adding value. I mean, I think there's a lot of things that you can go and combine. You must remember that in passive, you are getting the aggregated view. And I mean, you could see it in those returns that by just following broad markets, following a strategic asset allocation, you get a really good outcome. As soon as you're adding factors into it, you are adding a degree of noise into it, which can lead to underperformance and also complexity. And so, I mean, my broad view is to keep it simple: is pick your active, pick your passive. Don't have too many funds, because then you effectively start building your own passive, but just a very expensive version of it.
I think you raised a good point. If you are using smart beta, you are introducing noise. And then maybe it's something you need to consider, whether you want to diversify away that risk and noise, as Amy spoke about.
Yeah.
Okay, cool. That was a good point. And then on this topic of noise, and how would you actually determine what is the ideal allocation to passive? So Amy spoke about it reduces noise, but how does it fit in? And we also had a question on that earlier. Like, how should I be applying this to my clients now?
So, I mean, broadly, if you look at the math, 50% of the assets, and I think quite importantly, we're not talking about the average manager, we're talking about the peer weighted average. So in other words, if you look at that return, the top 10 funds in the multi-asset high equity category make up 70% of the assets. So effectively, that return is largely determined by those 10 largest managers. So if you're allocating across those, a large percentage of it is by definition going to underperform before fees. And so, I mean, if you look at what's happening globally, people are moving closer and closer to 50% and beyond. It makes sense to reduce a lot of your risk and your costs by having at least half of your assets in passive, and then being more selective in terms of the active managers that you go and blend with it, and less is more. If you have too many active managers, then you're also diluting some of their views and adding, I think, you're moving closer to the market.
Yes. Cool. That's all from our questions. Thank you very much. It was very interesting to hear the journey and share it with everyone.
Thanks, Daisy.
Thanks, Jannie.